All right, thank you everyone for your patience. So welcome to today's session on maximizing your SRS. My name is Jason. I'm part of the advisory team here at SIFE, and I'm very excited to host you this evening together with a very impressive lineup of speakers and panelists. So personally, I'm very much looking forward to what we have this evening. It's going to be a very different format compared to our previous sessions. Right, we've invited some wonderful speakers this evening who will share with us their different perspectives from individual investors' perspective as well as from an institutional point of view. You will leave this session with a lot of takeaways. So before we begin, some housekeeping matters. For those joining online, there's no Q&A segment this evening. Right? And after the session, if you still have questions, I will share with you how to reach out to the advisory team. We'll have a fireside chat to kick us off this evening. Right? Sort of open up the floor, introduce us to a bit of SRS investments. Thereafter, we'll hear from the finance specialists themselves, right, from an investment offering point of view, right, and how SIFE's SRS offerings can fit into your portfolio allocation. For those who are physically present here tonight, you may also approach the speakers after the session. Right? There's a couple of booths outside. There's refreshments as well. Right? So, a brief introduction of the speakers here this evening. First up, we have Ritesh, MD and Head of Investment and Advisory here at SIFE. From Lion Global, Darius Fu, Senior Director and Head of the Distribution Business. And from Amundi, Dennis Ng, Head of Distributions and Sales. All right. And Teresa Francis, Associate Director with the ETF, Indexing and the Smart Beta team here in Singapore. And of course, our panelist speakers are representing Dollars and Cents, Beansprout, and Budget Babe. So for the benefit of those who are joining us here for the first time today, let me give a quick 2-minute introduction to SIFE. SIFE is a digital investment platform. We seek to empower our clients to build their wealth for a better future. Right? We are headquartered here in Singapore. We are also licensed by MES. We have a mobile-first approach, right? And essentially what that means is managed portfolios, cash management solutions, and our brokerage platforms. They're all on a single app itself. Right? And what this does is it allows our clients to be able to invest in a very holistic and seamless manner. The advisory team then adds on that extra layer of value add and guidance. We are trusted by 100 over 1,000 users here in Singapore, right? And this is a quick snapshot of our journey to date. So we launched in Singapore July 2019. We've gone through several significant milestones since. We recently raised our Series C's funding round of $27 million this year. We've achieved profitability here in Singapore as well. Average client assets has more than doubled since 2023. Right, without further ado, let me invite the panelist speakers up on stage to join me. Please. Right, I think before we pass the time over to the speakers, I'll just give a quick introduction about SRS for those who are unfamiliar with what SRS is. All right, so SRS introduced in 2001. It's a voluntary scheme. It's not mandatory like CPF. Right, it's open to all Singaporeans, foreigners, and PRs as well. Right, and of course, contributions to SRS provide some tax relief. So this is a quick example of how much potential tax savings you could gain via SRS contributions. So if you have an annual income of 120,000, right, and you top up the maximum annual limit, 15,300 for Singaporeans, right, you could save potentially more than $1,000 worth of taxes, which is not insignificant, right? This is the current landscape of SRS allocations, right? So on the left-hand side, you see a composition of the investments. What's noticeable here is cash balances account for close to 19% of all contributions. Age profile in the middle, account holders under 45 years old, they make up close to 60% of all accounts. And of course, the last one is the nationality profile. So Singaporeans actually account for more than 80%, right? Followed by PRs and foreigners as well. All right, so on to the panelists, right? Maybe if I can kick us off with a quick introduction question, right? As well as what are your current priorities? If you can share with us a little bit, right? Maybe Tim, you'd like to go first?
Sure. Hi, Timothy. I run this financial website called Dollars and Cents. We write a lot of articles. I've been doing it full-time since 2015, so about 9 years plus already. During that time, I also have 3 kids. So I have a 7-year-old, 5-year-old, and 2-year-old. So I'm glad to be here. I was just sharing with them that I have talked about SRS so many times, but I'm always excited to talk about SRS because I feel like that's just one of the topics that you won't really see the government actively educating you about it, right? And we can share more about the reasons why later.
Thanks, Tim. Gerald?
Hi, my name is Gerald. I'm the founder of Beansprout. We are a financial insights platform. Tim started earlier than myself. I started in 2021. And so far, we've been sharing our financial insights with consumers in Singapore about investing in various asset classes. Prior to that, I was an investment analyst at a research firm in Singapore. I think how my career has actually shaped up has affected how I think about investing. Given that I just started my company a few years ago, a lot of what I focus on these days is on generating passive income so that I can really be focusing on my work. This may not be something that I spent too much time thinking about in the past, but as I will share later, a lot of my investment strategy, how I think about how I allocate my portfolio will be based on really generating many different passive income streams.
Hi, I'm Dawn. Some of you might know me online as Budget Babe. So I've been doing this since 2014. And I've been initially started out as sharing my own personal finance journey. And then later on, I got invited to talk about and share tips and hacks to help people save money and build their wealth faster and earlier.
All right, thank you. So I think kicking us off, retirement planning, right, often involves 3 avenues: CPF, cash, and SRS. So I think maybe in terms of these 3 avenues, could you actually share with us in terms of allocation? How does one go about deciding the allocation?
I'll just go first. All right. So I think when it comes to retirement planning, I mean, yes, there's the cash investments, but for those of us who are in Singapore, most of us, we know CPF is the thing that we have to contribute compulsorily. It's mandatory, right? So most of your retirement nest egg will be a large part of it will be in CPF naturally because it's compulsory. Of course, CPF you can use for education, you can use for housing, which a lot of us also use it for that. I think the key thing is that the CPF system is kind of designed in a way where if those of you in the 1M65 community, y'all will be experts in all those things, right? There is a limit to how much you can top up, right? So it's designed to ensure that people have that basic income when they reach the retirement age. And not necessarily to have that very extravagant lifestyle when they retire, right? So it's meant to form the base. And then of course you have SRS. SRS is where, you know, it's optional, right? You can earn tax relief if you contribute to it, but it's optional, right? So if you want more for your retirement nest egg, that's where people can use SRS to enjoy the tax relief. And then of course to invest their SRS, because with SRS you don't earn returns. It's unlike your CPF where you don't need to do anything, you get 4% in your SA, right? For the SRS, if you top up your SRS, you still have to invest it. Otherwise, you earn a nominal interest rate of 0.05% from the bank, and that's obviously not good enough. So I think that's just the breakdown. And of course, you can have your cash investment as well.
Yeah, maybe just adding on to what Tim has shared and the statistics that Jason showed us earlier, I think what really surprised me when I first came across the data set was that close to 20% of all SRS contributions are not currently invested. And I think that is where the opportunity really lies in, because as we know, 0.05% can hardly beat inflation at this point in time. What we also see is that there have been more investment options for investors that can then allow us to find something that actually suits our own investment objectives, risk appetite, as well as time horizon.
For me, I see my CPF as like the bond-like component, so I don't invest my CPF. And I think most people should ideally not touch it because it's something that already generates you returns without having to do much. And then for cash, it's quite easy. Most of us, we can open a brokerage account today in under just a few minutes by just linking your SingPass. So there's a lot of options. But when it comes to SRS, that's where the difficulty lies, because not a lot of people have that option. And I think there's this misconception that if your SRS money is sitting in any of the 3 local banks, you can only invest through them, which is not true. You can actually link it to your preferred brokerage or platform to actually invest in other options that will give you more variety and choices to choose from, more access basically. So that is really starting to change. I think we're seeing more options nowadays, especially with Zive launching it, and that should ideally help more people be able to invest their SRS. One of the things I talk about with my readers is that they put their SRS money in to reduce their taxes, but they leave it sitting there because they don't know how, and it's not that straightforward to invest it. So I hope this changes soon. We should see that 20% drop further.
Yeah, so I think Don kind of jumped the gun here, talking about misconceptions. We'll talk about misconceptions as well later, right? But I think, Gerald, you talked about time horizons. So maybe can you share with us, like in terms of short-term goals and long-term goals, how do we actually view it then?
Okay, I think this is a very pertinent question because as I often share different investment insights, I think a lot of investors are very commonly focused on just the investment returns, which is linked to your investment objectives, but less focusing on your risk appetite as well as to consider the time horizon. I think often we see discussion just around, okay, this product gives me a higher yield versus the other one, and hence is this just a better product compared to the other one that I'm thinking of. But I think we also need to take into consideration these 2 other dimensions. And I think of the 3 of them, the time horizon is the one that most people do not think actively about. I think just using myself as an example, what I actually invest in for my short-term needs may be very different for what I have in terms of my longer-term retirement planning solutions. So just as I shared earlier, because now I'm running a startup, I may not have the visibility on my monthly income. So being able to generate a passive income from my investments then become very important. And I need to make sure that my investments are able to help me generate this passive income. So there is a short-term need to actually generate this income, whether it's on a quarterly, monthly basis, to be able to meet some of my lifestyle needs. But at the same time, I am also starting to think about my retirement. I think amongst all the panelists here, I might be the one closest to it, since I'm the eldest, not that I've earned the most. So I think that is something that I would encourage everyone to think more actively about. I think it's another thing that I realized after writing more frequently on Beansprout is that when we talk about retirement planning, it's not something that people actually think much about, especially for young adults who have just started working. Often it's just about what I want to be able to invest in to earn the highest return over the next 12 months, 3 years, 5 years, but we don't actually take a longer term time horizon to actually think about how much we need for our retirement and to actually start planning for it.
All right, thanks, Gerald. Anything to add from Timothy? Or all right, so I think looking at the audience here today, right, like some of us are obviously in our 50s. What advice would you give them when it comes to SRS?
I have a thought here on like just people who are maybe in their 50s, right? I think SRS is even better for them simply because of the fact that they are closer to retirement, right? As some of us should know, you can only withdraw your money penalty free after you reach the statutory retirement age, right? So for young guy like me, for example, right, maybe I got like 20, 30 years more to go. So it's a lot of time still that, you know, if I top up my SRS today, that it will be in my SRS account. I can take it out, but I will be penalized, right? Whereas for people who are older, let's just say you are 60 and your statutory retirement age at that point was 62, right, you are actually just 2 years away from withdrawing the money, right? So if you're still working and you're still paying a high income tax bracket, you top up your SRS, you immediately get the tax savings, and the truth is 2 years later, you can start withdrawing already. So I think that actually benefits people who are closer to retirement. In my opinion, and this is just my opinion, CPF benefits people who are younger, right? I explain to you why. If you top up your CPF today when you are 25 years old, you put in $10,000, it has 40 years to compound. That's a lot of money. But when it comes to SRS, it favors people who are older because they are even closer to they earn a tax break and they are closer to being able to withdraw the money. So that's my opinion.
Understand. And I think when it comes to tax reliefs, right, because you talk about it as well, how would you weigh SRS contributions against CPF top-ups also? Is there any specific scenario where one is better than the other? Maybe Dawn?
I talk about this topic a lot. Actually, there's a CNA video as well where I address how to reduce your taxes using these different mechanisms. So the easiest way that is within our control, of course, is the CPF top-up, because when you top that up and you let it compound over time, as what Tim said, you really do get pretty good returns. So it's definitely worth it. And don't stop at yourself. I usually also I do it for myself, my husband, but I also always tell my readers, top up your loved ones as well. Yeah, so like I have this article in my blog from I think 2016 where I wrote about how if you're Asian and you need to give your parents filial or pocket money, right, allowance, don't give cash, give CPF. And my dad was very happy with that concept because he was closer to the retirement age, so he can get the money out faster as well. And in fact, it's better because if I give them cash, realistically speaking, what are they going to do with it? Right, they have enough money for their daily expenses, so they'll put it into the bank, and it's a 0.05% interest rate because they don't know how to use high-yield savings accounts like we do. So what happens then is if I put it into their CPF, it's actually growing for them. So I would say that's the first step that most people should look at because it's very easy and you have a huge amount there that you can use to bring down your taxes. The second step then would be, of course, to look at SRS. And then if you can put up to the max, I think for foreigners it's 15.3. For locals it's 15.3. For foreigners it's more, over 30k. That can actually reduce your tax bracket and you can save a lot more than just earlier on the example of 1,000, but depending on where your income is, you can actually save several thousands from using this. And then of course, the other stuff like dependent reliefs and everything, really look at the IRA's website because there's so many different things to do. But what I always would say is the calculator is one of the easiest way. Put in everything as much as you can, see whatever you can deduct, and usually the ones that you can really control is the CPF and SRS.
Right, and we talk about withdrawals quite a fair bit, right? And in my day-to-day role, actually, when it comes to SRS, I do get a lot of questions, and one of it actually centers around withdrawals, right? I think that's a major concern. So I think to move on to the next part of withdrawals, right? So this is a quick breakdown of some of the regulations around the withdrawal. So obviously, as what the panelists have actually shared, you can only start drawing down on your withdrawals after your retirement, right? And once you start withdrawing, only 50% of it will be taxable. Of course, because this is a voluntary scheme, if you do early withdrawal, you can also do so. There's a 5% penalty, and of course, tax-wise, it's 100%. Right. So I think when it comes to withdrawals, there is this concern, right, that if your SRS portfolio is too big, right, and when you start looking at withdrawing it, there comes a point of time where there's a significant tax liability, which will then potentially offset the tax benefits. How can one address that?
Yeah, I will try. There's a lot of dollars and cents calculation approach here. And I get the question because I think this is the smart question to ask yourself, right? As the scenario above have already shown, 400,000 is kind of like the nice number to have, right? Because you can withdraw 40,000 for 10 years and then 50%, so 20,000. And first 20,000 is tax-free. But that also assumes that you don't have any other taxable income that you also have, right? So I personally wouldn't cut it so close to 400K. If you ask me, I think my personal thoughts is that you don't want to pay any tax ideally for your SRS when you withdraw it, right? And that means that your portfolio cannot be like $2 million, right? Because otherwise then it's a bit troublesome, right? What I typically would consider for myself is that I want to earn the best return possible when I contribute to my SRS account, right? So that means you must be in a high tax bracket, so that when you contribute to your tax, to your SRS, you get first dips of, like, you know, if you're in tax bracket of 10%, you get a 10% return immediately. I think the the speakers later will share different options, but essentially, if let's say I want to huat on a stock, for example, I wouldn't personally use my SRS money to huat on the stock, because let's say I 10 times my gains, then now I got capital gain that I have to pay when I withdraw, right? I would prefer a more stable return that I can roughly forecast that, okay, I put in 20,000 today, how much will it grow over the next 10 to 20 years? And then if I want to huat on a stock, I use my cash to invest in that stock. That's my opinion. Yeah.
Thanks, Tim. Gerald?
I'll go. So basically, I feel you can afford to go beyond 400k. Yeah, I think like you can even go to 600k. I explain why. When you use SRS primarily first as a tax reduction tool, it's usually because the taxes that you pay are at a higher level. So the SRS can easily help you shave off 1k or more in terms of your taxes. Okay. Now let's use 600,000 for instance, and you withdraw over 10 years. So that's 60,000. That works out to be about $5,000 a month for spending. Not too bad, right? Now, if you're at 60,000, if we just use today's income tax rates, okay, that will give you a tax payable of about $1,400, which still isn't a lot. Okay, I mean, it's better. Obviously, zero is better. But if you think about it, 1,400, don't forget, from time to time, the government also give rebates, right? This year, the budget rebate was $200. Yeah, so you would...
Only 200, yeah.
Yeah, only. Okay. Don't forget, you can still potentially offset other stuff, right? You can always go for a course, then upskilling, you offset. So depending on what your rebates are, you can play around to still bring down the taxes that you pay. Yeah, even though you're not working, but this is technically, it's like income, right? Then you can look at what are the other subsidies or rebates and reliefs that you can make use of in order to take out. Who knows, you might even want to top up your CPF or other stuff to get more down. So there are ways to still, I shouldn't say avoid tax, but to reduce your tax bill in very legal manner and acceptable manners as per IRA's regulations. So don't stress too much about not growing your SRS portfolio. I think 400 is a good number. And in reality, if you contribute to your SRS at the maximum 15 or 30k a year, right, it will still take you some time to get to that 400 or 600k mark. Yeah, especially if you're not doing like super aggressive investing. So you can still go and grow it without worrying too much about the tax payoff, because there are ways around it.
Thanks, Don. Right. Yes, I also wouldn't mention the word tax avoidance here. Right. So I think part of SRS is a lot of misconceptions, and I think let's do a quick fire round. All right. I'll ask you guys some misconceptions about SRS, right? That I've heard a lot, and let me know what are your thoughts. So maybe for Timothy first, is SRS only relevant for older individuals, or can younger folks also enjoy it?
I think there's two groups of people, right? The first is really foreigners, actually, because foreigners don't enjoy CPF contribution, right? So if I make $5,000, $1,000 straight away go into my CPF account each month, I contribute, and that is tax-free, right? So a foreigner who makes $5,000 doesn't get that. So minimally, the person should maybe consider topping up $1,000 to enjoy the tax-free. So that's the first group of person. And the second group is it's not so much of whether you're older or not. It's actually how much you make, right? So you can make a lot when you're young. In fact, MOM stats shows that highest income, median salary, highest income is actually age 40 to 44. So it's not necessarily the older you grow, the richer you become, right? At 40 to 44, statistically, your salary kind of peak, all right? So I would just be more focused on the income. And then secondly, the other thing I also notice is that if you are really enjoying a lot of tax relief, right? So if you are like Jason or me with 3 kids, then the chances of you paying a lot of tax is quite low because of your children, right? Whereas someone who is younger and maybe don't make as much as Jason, but doesn't have kids, may want to consider topping up because they are not enjoying as much tax relief, right? So I think these are something to take note of lah.
All right, thanks a lot, Tim. I have no idea where he got that conception from. All right, maybe next I ask Gerald. There's a common perception that SRS is exclusively for high-income earners. Accurate or not?
Okay, I think the way I look at it, if you put in your income, taxable income into any SRS calculator, put in your tax relief, then it would appear that someone with a higher income would be able to save more mathematically from the SRS scheme versus someone with a lower income. But I think for me, when it comes to personal finance, it's always a matter of what I can best do as a next step to be able to grow my wealth. Right. So then the question is, even if I am someone with a lower income bracket, does it actually still make sense for me to make use of this scheme to be able to get some tax relief or be able to optimize my entire portfolio? So I guess from that perspective, I think from the example that you shared earlier, for someone with an annual income of 120K, 40K tax relief, you are still able to save potentially about $1,000 of tax from the SRS scheme. So I think so long as it's something that has a net benefit, it should be something that we should all be educating ourselves about and thinking about ways that we can make use of this scheme to be able to grow our wealth.
Thanks, Jared. And of course, considering the time horizons as well, right? Yep. So, Don, some people believe that, maximizing CPF contributions is actually more important than SRS. What do you think?
I think it depends on each individual. Because your CPF has mentioned you can do it on yourself and your loved ones. So you have quite a bit of money to spread out and reduce your taxable income by. If after that, your income is so high that you have a very happy problem, you still have more room to reduce it further, then SRS is a great tool. But at the same time also, we need to think about what you do with it. Because if someone opts for the CPF option and never do anything, hey, you're still earning returns. Right? But if you opt for the SRS and you're among the 20% who leave it in cash and you only earn 0.05%, then you are losing out to inflation. So in that case, then maybe you shouldn't even have done the SRS approach, because if you had just paid your higher tax bill and you take your cash and maybe you invest in something else, like the stock market on through your brokerage, or you go and buy property, or you go and buy whatever asset that you think, or you invest in yourself to, get more salary at your job, then that could yield better returns. So it's always about which move, what works for you, how much room do you have to play with, and then what are the outcome that you get, not just in the immediate but also in the mid and long term.
Right, thanks a lot, Don. I think as we conclude the first segment itself, of course I do thank the panelist speakers. Perhaps what is one key takeaway that you would like to leave the audience with this evening?
I'll go first. I think it's very important for us to always consider how we invest our SRS savings with reference to our overall portfolio, right? So you shouldn't be investing your SRS money just thinking, okay, this is the best returns I can get based on the next 10 years horizon. You should take it into consideration with what else are you investing, right? So for example, SIFE have multiple investment options, right? I'm a SIFE investor, so I invest in SIFE, and I would take into consideration what I'm really investing in through them, right? Equity 100 perhaps is an investment I'm using my cash to invest in. And then maybe for my SRS, I might consider Income Plus, for example, right? And my reasoning is very simple, because I think Equity 100 have more upside. And so the last thing, it's a good problem, but I don't really want a situation, unlike Don, I wouldn't pay a single dollar more to IRAS if I can help it, right? Where I have to end up paying income tax because my Equity 100 portfolio reason in terms of capital appreciation, and then I have to sell it, and then I have to pay tax to IRAS, right? So I'll rather keep it as my cash investment, whereas Income Plus has a more predictable growth in terms of the revenue, right? So I would do that. So just take that into consideration, that your SRS investment should not be made independent on other investments you're already making.
Okay, maybe I'll just add to that as well. Given the discussion around the different options that are available, how do we allocate between SRS, CPF? I think apart from looking at it from an entire portfolio perspective, the other key consideration is that different pots of money may not have the same investment options available to you. So apart from looking at it from your own perspective, I think it is also worth considering what are then the investment options that are available. The good thing about SRS is that compared to CPF, there are more options that are available. And then for someone like me who is looking at generating many different passive income streams, I can look at something like the Income Plus to then think about, okay, maybe I can access certain income funds that I might not be able to access using other pots of money. And then I think that is how I'll look at it, apart from thinking about the investment objective, risk appetite, but also then what I can more easily buy using SRS versus my other pots of money.
I think from my side, I would talk about asset allocation because most people, I mean, we're all humans. We want to get the highest possible returns with the least amount of effort and work, right? But realistically speaking, we don't have that bandwidth to juggle our career, our family, our elderly parents, if you're stuck in the sandwich generation like I am, and still invest your cash, your CPF, your SRS, and your property portfolio or any other assets that you hold. It's very draining. So an easier way to think about it and to optimize it, I would say, is usually I tell people, I just share my approach, and then you can decide if that helps you to design yours. And how I look at it is my CPF is my bond. So that's the I don't touch, I just let it work. It's the super safe government bond, right? And then my emergency funds, I usually just keep it with the banks in high yield or in fixed deposit or in treasury bills. Easy peasy. I just rotate maybe 6 months or 1 year, okay? And then with the SRS is where I would put in as like a base. So I invest in broader funds so that I don't have to be worried if the news tomorrow comes out that this stock or this country, drop. Like, that's the major change. I don't want to have to suddenly, oh my gosh, I need to do something in my SRS portfolio now. So that's how I think about my SRS and where I pay the most attention to, because this is also where the biggest pot is the cash. Right? Most of us, I think, will reach a stage of our life. I'm in my 30s now. I know I look younger, but I'm not. I want to look forever 21, but I am actually in my 30s, and the cash portfolio is the biggest portion. It makes more sense to put the most amount of time and effort on where the money is bigger. So that's where I will be a bit more aggressive. I'll go into equities, and I won't really use that cash portion so much for the safe stuff like bonds, unless it's the emergency cash. That's a different pot of cash. Yeah, so that's how I allocate my time and my skill set in order to optimize the overall portfolio. Of course, you could argue that, hey, but you could put everything into maximum. But realistically speaking, nobody can do 100% effort in every single pot. Yeah, so we just need to do what works for us, and that's the method that I found to work for me.
Thank you, everyone. So before the session, I actually asked them for their one sentence key takeaway. I think what they shared was more than a sentence, definitely. Right. So I think from Timothy, Gerald, and Don, this is their one key takeaway for this evening session. Right. As we conclude the first segment, right, I think let's give them a round of applause, shall we? All right, so I won't hold them up too long. I know they're incredibly busy. In fact, one of them actually has to rush off after this speaking panel itself. Right. So, all right, let's move on to the next segment, shall we? Thank you, guys. Sorry, I need a clicker, guys. All right, no worries. As they find the clicker for me. So in the first segment, we've managed to cover some significant grounds in terms of SRS investments from the individual investor's perspective. Up next, we'll have the finance specialists. All right, so I think first up, we have Ritesh from SIFE, who will give us some of the investment options available. All right, Ritesh, please.
Hi, everyone. Does it work? Yeah, all right. Hey, everyone. Good evening. Thanks for being here. Very excited to see the launch of SRS Investing with SIFE. Now, obviously, you guys saw in the panel session that SRS investing, how can you optimize your tax benefits? But obviously, even more important is how do you grow your SRS monies as well? And we saw that there are challenges when it comes to investing your SRS monies effectively. So first of all, thank you, Don, Gerald, and Timothy for the insightful session. Let's quickly dive into some of the challenges that clients face when it comes to investing your SRS monies. So I think it was covered in the panel session as well that there are very limited number of products available that you can invest into from an SRS standpoint. So, obviously when it comes to cash, the whole world is an oyster, so you can invest as you want. But when it comes to SRS, there is only a limited number of products that you can invest into. Similarly, not all platforms actually enable you to invest your SRS money seamlessly and all as well. So that's another challenge. Even if you know which product to buy, then there are a limited number of platforms through which you can buy these products from. And obviously, there are certain products which have lack of transparency and they are associated with very high fees. These severely limit the ability for a lot of investors to actually make their SRS investments to work. And that's, I think, partly the reason why 20% of SRS money is still idle, sitting in cash, earning a solid 0.05%. Now, can we do better? 100%, right? We can. But again, what are the options available right now for investing your SRS? So you can invest into Singapore government securities. So these are obviously super safe, but also very low returns, right? So you can hardly beat inflation, 2 to 3% in the long term. They're also less flexible because you need to hold them for a certain duration, and there are certain denominations with which you need to invest in all as well. Similarly, fixed deposits, again, very low return, and there are liquidity constraints, etc., and all as well. Then you have endowment plans. These are typically, again, less transparent. They have a lot of embedded, fees, etc., and all, and they kind of lock you for a very long-term commitment. So if you, signed up for something and it was not great, there is no option for you to, come out of it. And there is huge penalties associated with these aspects and all as well. Then, of course, you can invest directly into shares, ETFs and REITs. These are primarily, I think, the more local shares, REITs and ETFs that you can invest into, not the global. I think there's limited options there. But here, I think then the challenge is, you need to self-select, you need to be ready with the volatility associated with these, and there are less diversification benefits, etc., and all as well. And again, I think it was mentioned during the session as well, that if certain stock you invest and there is huge volatility up or down, that can both be, not so great specifically for SRS investing. And then unit trusts, and this is an area which is, I think at the heart of the problem, because obviously all of us want to invest in a globally diversified manner. And till now, I think the number of options available for investing into, the SRS side, especially on the unit trust side, was very limited and curtailed to very active managers which have almost 1 to 2% costs embedded and all. And that can significantly, impact your long-term returns as well. So with those options in mind, I mean, this is the reason why on SIFE we have, tried to specifically address these concerns and build portfolios and solutions such that you achieve greater diversification, you have reduced costs, and things are much more flexible and in your control, right? So as you know, our platform, there are 3 specific verticals. We have our managed portfolios vertical. So here you can get all these long-term growth-oriented solutions, income solutions, as well as, other REIT-oriented solutions. We have our brokerage, arm through which you can access Singapore, Hong Kong, and US stocks. And then you have the cash management where you can deploy your idle cash, and it is much more flexible and all as well. Now, for SRS, what we have focused on is the managed portfolios and cash management. And the reason, again, is we want to give you a diversified portfolio solution, fuss-free, very easy to deploy, very simple to understand, and it solves some of your key objectives as well. So what that means is, essentially, there are 3 products that we have, built, and these are tailored to your different needs, right? So I think the first step that anyone needs to take when it comes to SRS monies is, if you have money in SRS and it is lying in the bank, that's the worst thing that can happen to it, right? So the first thing to do would be at least make it work a little bit harder, right? It might not beat inflation with a cash product, but at 3.5%, it's decent enough to start earning something, gets closer to what people get with CPF, etc., right? So that should be, in my opinion, the first step for people to just, as soon as you contribute to your SRS, you immediately could invest into something, like a cash plus flexi. It is basically investing into money market products, which underneath does have the same instruments like government bonds, treasuries, fixed deposits, etc., as building blocks to this portfolio. And we've again built this in partnership with Lion Global, and they will cover this in more detail in terms of why this is a better way to deploy your cash, your idle cash, rather than it sitting idle and earning 0.05%. Then, of course, Income Plus. If you are someone who wants to use SRS monies as a more stable kind of, your allocation and earn dividend income, I think Gerald was, very much focused on dividend income as one of his primary tools. So this becomes, again, a great, avenue for you to invest your SRS monies in the bond, part of it. We have partnered with PIMCO to implement these portfolios, gives you access to institutional funds at lowest cost as well. And then, of course, I think in order to maximize your SRS gains, then I think it becomes important that you have the equity kind of portfolio as well. Now, for some, you would want to maximize your SRS gains. Yes, there is tax implications, etc., and there were like different levels that you want to grow your SRS monies and all. But in general, we all want to maximize our investments in SRS or any investments that we do. So Equity 100 gives you the chance to maximize your growth. You can see the returns, tends to go from, lower to higher as you move from flexi, cash, income, and equity. Obviously, the risk increases as well. On Equity 100, again, I think this is a game changer that has happened, for SRS investing. Previously, as I told you earlier, there were a lot of like active funds available, and the cost of investing into those active funds were very high, like 1.5%, 2% even, and that significantly erodes your long-term return potential. So now, with Amundi and Dimensional, we have been able to create these portfolios with a very low fee component. And, again, kudos to Amundi because, they have really led the way in terms of building, these, blocks of investments where you can diversify instantly through these very low-cost solutions, which was previously not available. So going a little bit quickly into the individual products. Okay, so Flexi, of course, I think, number one, it is low-risk portfolio built for, consistent and steady returns. Using money market funds, which basically mean it is your deposits, it's your Singapore, government bonds, treasuries, etc. So you're really investing into very high quality, stable, safe kind of, underlying instruments. There is no lock-in, there is no minimum, so you get all that flexibility. So compared to your fixed deposits, your, government bonds, etc. and all, you can put money in today and you can, take money out tomorrow. Though I don't think that is the way that you should use it specifically for SRS. But the idea should be that at least make your money work harder from that 0.05% to, immediately get to 3.5%. How have we built it in terms of the actual strategies? Oops. Okay. So as I said, we partner with Lion Global to build this portfolio. There are 2 money market funds that we have incorporated, and as part of the asset allocation, the average credit rating is A- and A, I think, overall. So that's really high credit quality, primarily built using money market instruments such as commercial bills as well as deposits, etc. And I think the great part about this is again the fee, right? Overall, you can see that you get 3.5% net returns to you. And that's because the funds themselves give you 3.76%. Now the fund level fees is close to 0.3%. But what is important is there is trailer fees that we get from Lion Global, but we pass 100% of those trailer fees back to you. So the net cost of investing into these funds comes down to only like 16 basis points. And then we have our own 10 basis points, very nominal fees on top of it. Meaning that you net get 3.5%. So I think overall this is great because if you were to invest in these individually, potentially with different platforms, you will incur a much higher fee and you might not get any of these trailer fee rebates, etc. and all. So net, you're better off investing into these underlying funds through a solution like Cash Plus Flexi. Now coming to Income Plus, obviously the focus is dividends. And in order for us to give you access to the best bond portfolio in the world, we have partnered with PIMCO and we have gotten access to their institutional funds. So now as an active manager, they obviously have higher fees associated with those funds. But because we are using the Insti share class of these funds, the costs are reduced by more than 60%, right? So more of your money, gets invested and generate returns. The other parts of the portfolio, some USPs are, again, it is SGD hedged, so you get your returns in SGD terms. This is tax optimized from a withholding tax perspective and all, because when it comes to dividends, you obviously want dividends not to be taxed. So these are UCITS denominated funds, which means that your dividends are taxed at a lower proposition. Next. Oops. A little bit. I don't know where to. Someone help, please. Oops. Okay. Yeah. So, some of the key benefits, I think it quickly highlights the yield to maturity. So gives a rough guidance of the kind of total returns that you can expect to generate from these portfolios if you hold the underlying bonds to maturity. There is also monthly dividends that are paid out. These dividends are actually reinvested back to the portfolio, because obviously for SRS, the intention is for you to generate those dividends and reinvest back into the portfolio and grow the portfolio, versus taking these dividends out, the money will still remain in your SRS account, right? So better to reinvest it for that longer duration. And again, high quality in terms of credit rating, as well as, medium duration, so you don't expose yourself significantly to interest rate risks as well. So overall fees, as you can see, just going back, oh my God. All right. So as you can see, there is a lot of fee savings that you are getting as part of this. The underlying fees of the Income Plus strategy is at 0.65%, and then the SIFE fees apply at 0.25 to 0.65%. So the total fees that you end up paying is 0.9 to 1.3%, versus if you were to access these funds directly, again, you will end up paying more than 1.5% for the same funds if you access them from a retail client standpoint. And then there are various sales charges, especially if you go to the bank, they'll apply at least 1 to 3% sales charges, and there might be additional wrap fees, etc. as well. Now, quickly, I think beyond Income Plus, obviously, we want to maximize our returns from our SRS portfolios, and that brings me to Core Equity 100. So this is our flagship portfolio, which we have now launched for SRS investing as well, launching it in partnership with Amundi, where they have brought together, these index solutions into the market first time in Singapore. And because of that, what we are able to do is build you a globally diversified portfolio. It is, using best-in-class, low-cost index funds, as well as, this is managed expertly by, the SIFE team. So my team would look at the constituents, continuously re-optimize and rebalance it such that it, continues to generate optimized returns for you over the long term. Bit more time. So I think quickly highlighting how we screen for the funds, I think there are a lot of funds that are available as part of the screening process, and this is where the investment process shines up. We go through a lot of data in terms of shortlisting the different funds that we choose as the underlying components of the equity portfolio, and that includes looking at the expense ratios, the liquidity, tracking error. We look at UCITS tax optimized funds and all as well. So these are all things that add up and essentially go into the process where we are doing that homework for you such that you don't need to do that. And then once we have chosen the funds, it's really about putting them together in a format to maximize your risk-adjusted return. So again, it's a bit slow. Okay, so these are the actual funds that we use in our equity portfolio. As you can see, it is about 70% into the Amundi funds. There is a world fund, so you get a MSCI World kind of an allocation at 10 basis points, right? So this is what I was talking about. The expense ratio or the management fee of these funds are so low that it is kind of like unparalleled. You can't get access to these funds at these low costs. I think very, very limited options out there. So if you look at US investing, you can invest into this Prime USA. Again, 5 basis points. Emerging market allocation is there. Again, 20 basis points. And then there are a couple of overlays of dimensional funds to get you more value-oriented exposures as well. So the overall expense ratio is just 0.16%, which overall then means that the total fees that you end up paying from equity 100 portfolio is very low at 0.16%. And again, if you were to construct a globally diversified portfolio yourself using active funds, the cost will be 1 to 2% at least. And again, because of these costs, the actual total returns that you generate gets impacted. So usually you will see 6 to 8% kind of returns with these portfolios versus our equity 100, if you go back last 8 years, has generated double-digit returns there. So I think with that, I will take a pause and hand it back to Jason, such that we can get our experts from Amundi and Lion Global to talk a little bit more about the individual funds as well.
All right, thanks, Ritesh. Up next, we have Darius Fu from Lion Global, like what Ritesh has mentioned.
All right. Good evening, ladies and gentlemen. We're about halfway through, or rather 3/4 ways through. We're supposed to end at 8, right? 8. I have 15 minutes on the timer. I promise we'll try to end at 8, so I'll give it to you in 10 minutes. Now, we've been all sitting here listening to a lot of data, a lot of information throughout the last 1 hour. Let's see whether you guys have been paying attention, all right? So I need a bit of interaction back here. So if you take your money, you put it in SRS, how much interest do you get if you don't do anything? Oh, excellent, wonderful. Now, obviously, the first 3 panelists, they've already given you all the reasons why you should invest your SRS. So I'm going to take it for granted right now that all of you are on the same page. You are going to invest your SRS, all right? But tonight, as what Ritesh has pointed out, we at Lion Global, we are essentially, taking care of your so-called lowest risk bucket kind of an instrument. So in case you don't know what to do, whether you want to be medium-term, long-term, income-orientated, etc., as what my esteemed panelists have been talking about, and you need some time to go home, play with the online calculator and everything, immediately you can make more money for yourself simply by transferring it into the cash portion, the flexi portion of it, and earn more returns. Now, why do you need to do that? Now, this chart is essentially trying to tell you a couple of things. So if you look at the top right, and you can see like this blue portion, this gray portion, this is basically telling you during certain rate cycles. So for example, in a rising rate cycle, what will work for you? You need to put it in fixed deposit and bills, for example. And if you're in a stable portion, you need to put it in short-term bonds. And if you're in a falling rate environment, what do? You put it in slightly long duration kind of a bonds. So we obviously see throughout history, this is almost the last 20 years. So I'm going to take a step back so you can take a look. And we've responded differently during the entire period. So now in 2022, interest rate hiked a lot. So you can see that everyone, and yourselves included, all took your monies, you put it into fixed deposits, or you bought treasury bills, so on and so forth. Correct? Yes, okay, I see more nods around the head. So now the question is, a lot of all those, or what we call the easy money party is over. So you can't get 5% anymore, you can't get 4%. Today, if you're trying to actually get 3%, that's a little bit of a struggle as well. So what do you actually do? So if you go to the next slide and you have a look, and you see earlier on we talked about you can, well, basically hold it in cash or your SRS, you get 0.05, and that's your returns over 20 years if you do nothing much with it, right? Fixed deposits, you get a little bit better, so on and so forth. T-bills and so on and so forth. Those are all the different combinations that you can essentially earn your cash monies right now as well. Now, obviously, we're hoping that, as you partner with Saif on your, journey, you're not just looking at your cash portion, but in looking at your SRS portion as well. And if you're not, certain what is going to be the outlook for the future in, the next 3 months or 2025, for example, do we know whether Donald Trump is going to win, etc., etc., don't worry. All you need to do is park it right at the bottom here in LGI funds, because this is what Saif is essentially bundling together for you as a solution. So another way of looking at this is this. If I want to invest, I obviously want higher returns, so up here, and I hope that my duration is shorter, correct? Yes? Okay, who says yes? Can you just show me by waving your hand? Who says no? Who don't know? Who don't care? Okay, better care, since you're sitting here. Obviously, the best way to make money is to get higher returns up here and in the shortest possible amount of time. All right, so what we're talking about, and I think it's a similar chart that Rita showed earlier on, but we just try to condense it into one little concentric grid like that. So obviously, if you're intending to invest longer term and all that, and you want higher returns, and here we're not talking about like pure equities and all these others, we're really talking about more guaranteed products, secure products. The best you can get is some of those investments from, or rather the endowment funds from your insurance companies and all that. But what we are trying to offer to you all in bundling together today is a shorter duration kind of a product, but it gives you higher returns, which is where this bucket essentially is. So, obviously, I'm not asking you to read this chart, but earlier on, Ritesh also talked about the fact that when you invest, you need certain level of transparency. Agree with me? Now, some of you might also be sitting there because you're investment savvy yourself. And you might be thinking to yourself, well, if I'm going to use size product and they're just going to put into 2 LGI funds, I don't really know what's going on at the underlying component. So what we're here today is to share with you a little bit of the secret sauce. And the first thing that I want you all to just note is this little chart on the left-hand side. Notice most, if not almost all the colors are green. Yes? Yeah. What this essentially means is that we have had positive returns on the fund. In some of the months, it's 0-0 because obviously for that month, the income or the yield, whatever we got, was so slightly insignificant that mathematically it rounded back to 0. It doesn't mean that you didn't get anything. Mathematically, it rounded back to 0. But what you can see is overall, you're still getting positive returns. Now, I want to be very, very fair at 0.1, 0.1, some at 0.2, 0.0. It may not excite the whole bunch of you. But again, remember, this is supposed to be your safest bucket of instruments, your safest bucket of your monies. It's not meant to, do something very exciting or very volatile for you. If I didn't remember, it was, I think, the counterpart from, Beansprout? No, it was Dollar and Cents, right? He mentioned he likes something with a bit of a stability, right? So that he can cruise all the way to his $400,000. So this is something that you can potentially map out. You know what is the long-term returns, and if you don't want to overcommit or breach that 400,000 magic number, this is something that you can potentially look at. So obviously this is the money market fund. We have the fact sheets and all that outside at the booth, so I won't trouble you to read everything right now. You can always approach us later on. But it's a similar when you look at our enhanced liquidity fund as well. So in this one, this looks a little bit nicer. In fact, every single time period, we have returned positively. That means thereby giving you an income, all right? So when you put these two together as the combination, which is what Ritesh and his team has done, that's how we're able to achieve our 3.7, net off everything, you get your 3.5 number that he presented earlier on. Now, the only one thing that I will do is toggle back and forth, is to just show you again. When you look at all the names, right, whether it's the money market fund, you see MES bills and all these others, there are some that are obviously corporate bonds. Now, back to Don's earlier comment, right, if you would like to manage something like that yourself, sure, you can do it. Very easy. Go in, buy and all that. But is that the best use of all of your time to go and identify every single bond, or is it better to leave it to LGI to do it, and then we, in working together with SIFE, we planned out the entire thing for you. So as you go along the next, enhanced liquidity fund, you see that this is something very, very similar as well. Now today, there lies the problem as well. If you are going out as an individual and you're trying to buy the MES bills yourself, obviously, you're very familiar with the drill. You got to go and bid for it. You got to see the tender, whether you get it, etc., etc. Most of the times, you may get it, you may not get it. And even if you get it, you may not get the amount that you want. And last but not least, you may not even get it at the yield that you want. But as a fund manager, we are able to do it as a portfolio so that we can average out the outcome and achieve a better result for all of you in the longer term. Right, so my key takeaway is I hope that you all were convinced by the panel that you need to do something with your SRS monies or your cash monies today. Don't leave it idle in the bank. And if I didn't hear wrongly from the panelists earlier on, a lot of them, they talk about them having a lot of monies in the bank so that they have investment opportunities and all that. Now, as an investment person myself, I have to tell you, I'm completely the opposite. I've got very little money in the bank. Okay, obviously from financial planning and all that, they will tell you need to have 6 months, disposable income, etc., in your bank account. Now, for me, I have very little money. Before you point finger and say, because you earn a lot, so you got 1 month's salary enough already. No, I don't. But the reality is we live in a world today where I don't know of anything that you need to instantly pay cash within 30 days. Sorry to sound a bit morbid, even if you land in the hospital, funeral, etc., people don't expect you to pay now. You get what I mean? They still give you 30 days credit. You can use your credit card, settle the credit card later, so on and so forth. So as a result, even personally, I don't leave a lot of monies in the bank. I rather take everything out and utilize it out there. So my bank account is very low. I dollar cost average if I can. I lump sum, SRS, etc., so that most of my monies is as fully deployed as much as possible. So therefore, we hope that you will make the most out of your SRS investments. And if you are a bit low risk out there, we hope that you will consider using our product. Now, obviously, I'm going to hand the time next to my esteemed colleague from Amundi. But just to round off with a little bit of a reminder for everyone tonight, okay? And for this, I might need to surrender my mic. Can you hear me if I don't use the mic? Wonderful. Advantage of swallowing a microphone. So I hope tonight, of investment, whether it's our SRS or not. You ought to be a bit louder than me. It should be a habit. Thank you. Why? Because as a habit, even if you forget it, you're left with okay, that's right, thank you. And at the end of the day, you're stuck with a bit. And because you have it. So if you invest your SRS, like you said, you put it one time, you can't do anything with it anyway, right? You will forget it, you will park it aside. Sometimes you don't even remember how much you have in it. Obviously, no one wants to throw it away. But once it's a habit, habits always have an interesting way of coming back. That's why you as promised, 5 minutes, 19 seconds left on the clock. I hand the time back to Jason. Thank you, ladies and gentlemen.
All right, thank you, Darius. Up next, we have Dennis and Teresa from Amundi. I'm looking forward to their ending as well.
So if by now we don't really know whether we should invest at SRS, I think something is wrong. So nice one, Darius. Okay, so the title of my presentation is to recharge your retirement portfolio with the Amundi index funds. And I like the way it was used, because when you try to recharge an engine, basically you're trying to make the car go faster, right? So in a sense, when you recharge your portfolio using the index funds, basically what we want to do is to get you to your retirement goals as quickly as possible. So my job is quite simple. I'm just going to talk a little bit about the Amundi, give you a bit more confidence about the firm. We have over 100 million retail clients globally. We're the #1 European asset manager, and we have grown very well for the past 10 years. In fact, just to start off, about 2012, we were a combination and merger between SocGen Asset Management as well as Credit Agricole. So we started off like that, very humble beginnings. And then a couple of years later, we decided to IPO in 2014. In 2014, we continued to grow. We acquired Lixor, we acquired Pioneer, and we had a lot of more capabilities in both active as well as passive. In Asia, we have grown 7 times in the past 10 years to about $451 billion right now. In Asia, I'm happy to say that Singapore is the HQ of Southeast Asia at about $23 billion. And we continue to see very strong growth. We're one of the fastest growing asset managers globally. But what's very important today is to talk about the passive strategies. And that's where I'm going to hand off to my colleague very shortly. But we have 3 pillars: ETF, indexing, and smart beta. I won't go very much into this, but we'll be outside the booth to attend to any questions you have regarding all these points. But ETF is basically an exchange, traded fund. Index funds are basically very similar to ETF. It's just that it's a mutual fund format. And smart beta are basically actively managed passive instruments. Okay, but today our focus will be on the indexing. And just to give you an idea based on how fast this has grown, and we're talking about billions here, okay? The chart on the left shows the global growth of Amundi funds for the past 5 years. And Teresa just reminded me yesterday that Amundi has more than 100 plus index funds. Right now, it's about 214 billion, so we're double in the past 5 years. Can you see the global demand right here? On the right-hand side, there's a CPF included index fund, so more on the Singapore context. Just 4 index funds, now it's worth about 14 billion. And that has grown almost 4 times in the past 5 years. So that growth, that demand is very apparent. So this is where I hand it over to Teresa to talk about why the index fund. Teresa, over to you.
Thank you, Dennis, and good evening, everyone. It's good to see all of you here today. So my name is Teresa. I'm part of the Amundi ETF and indexing team here based in Singapore. So perhaps I'll start off by, explaining what an index fund is. So many of you here may already be familiar with what mutual funds are. Index funds are not very different, and in fact, they fall under the same broader category of mutual funds, but with 3 distinct characteristics. So as you can see from the slide, an index fund's main objective is to closely track the performance of a market index. And some of the market indexes which you may be familiar with are, for example, MSCI World for global equities, Bloomberg Global Aggregate for the global bonds, as well as S&P 500 for US stocks. And so with its index tracking characteristics, an index fund also adopts a rules-based approach to investing. So put simply, this means that an index fund adopts the rules and methodologies appointed by the index provider to decide factors, for example, when the fund should rebalance, what stocks should be included into the fund, and what their respective weights should be, as well as systematically including new names into the stocks, for example, when there are IPOs in the market. And so this essentially then brings me to my next point on an index fund provides investors a globally diversified portfolio of stocks and bonds. And so with all that said about SRS, why should one consider using index funds for retirement? So 5 key characteristics I wanted to share with all of you today. The first is cost. So index funds come at very low cost in comparison to their mutual fund peers. It can be as low as 0.05% in total expense ratio, as I'll show you in the next slide, and do not typically come with additional performance charges or hidden fees. The next is performance, which is also indirectly linked to cost. Index funds can offer superior performance versus their mutual fund peers as well. And the third point is diversification. As I mentioned earlier, index funds, through a single investment in an index fund, you can essentially get exposure to a few hundred to a few thousand stocks. And this reduces your chances of being overly exposed to a specific market or a specific stock, which can be quite helpful in terms of market downturn. And the last 2 points on this side, simplicity and longevity. This essentially means that with the index tracking characteristics, it typically offers a simple and simple approach to investing, as well as over the long-term investment horizon. And so just to give you a quick sense of cost of mutual funds here in Singapore, I'm proud to say that Amundi is one of the first and the low-cost index provider we have here. So we do offer 4 funds, 4 index funds available for retail in Singapore, also available for investment through SRS. And the average total expense ratio of these 4 funds is 0.11% per annum. But if we look at the overall market in terms of mutual funds that are available here in Singapore, the average fee across the global equity, global fixed income, and even multi-asset funds can go at about an average of 1.3% per annum. So this means when you choose to invest your SRS through SIFE's newly launched Equity 100 portfolio, which invests directly into the 3 Amundi index funds, you pay 10 times less than if you were to select a fund on your own. So with so much mention about costs earlier from the panelists and from my from Dennis as well, I wanted to showcase a quick example of how costs can directly impact your performance. So if you look on this slide, I'll take 2 examples, Fund A versus Fund B. Fund A is a higher cost fund with a total expense ratio of 1.3% per annum versus Fund B, a lower cost fund with a total expense ratio of 0.11% per annum. So, and we assume these 2 funds have the same return profile of 7% annualized on a year-on-year basis. Now, say, for example, we take John. and John is 30-year-old this year. He wants to start thinking about planning for his retirement, and he decides to invest in Fund A, the higher cost fund as represented by the blue line. So over the course of 30 years, John's invested 50,000 on day one and holds it for the next 30 years without making any further top-ups or redemptions. Over the course of 30 years, by the age of 60, John will end up with an amount of $257,000, which is not bad at all because his initial investment amount of 50K has risen by about more than five times of his initial amount. But what if I told you John has a good friend called Mark? Mark is basically a wiser and more thoughtful version of John. He does the exact same thing as John. The only difference is that Mark chooses to invest in a low-cost fund with a fee of 0.11% per annum. So over the course of 30 years, Mark's 50K has now grown to over $360,000, which is 7 times that of his initial investment capital. But not only that, in dollar terms, more than 100,000 more than what John has generated. So this is essentially just a simple and easy to understand example of when evaluating funds for all of us, we should seriously consider the underlying fees of how much it costs to invest in that fund. So as Ritesh mentioned earlier, Amundi has developed a very strong range of index funds that are available to all of us here today. There are 4 currently on the range right now available to Singapore investors, 3 of which have a 70% allocation in the Equity 100 portfolio, and these 3 are highlighted in the dark blue. First is the Amundi Index MSCI World with a fee of 0.1% per annum. Followed by that, the one on the bottom is the Amundi MSCI Emerging Markets Fund with a fee of 0.2% per annum, as well as the Amundi Prime USA with a very low fee of 0.05 per annum. As far as I can see, there are no funds that are cheaper than us, and we hope to stay for this for the long term. The 4th fund you can see on the bottom right is the Global Aggregate Bond. This is a mutual fund that invests into global bonds at a fee of 0.2% per annum. And so just to give you a quick overview of what these funds actually provide investors, I'll start off with the MSCI World Index Fund. So this fund essentially tracks the performance of the MSCI World Net Total Return Index. Essentially, this fund gives you an exposure to the 23 largest developed markets out there across 1,400 securities. So as you can see on the right, the fund invests into markets like US, Europe, Japan, as well as some of the very reputable names in the industry, including the Magnificent Seven, as you can see, Apple, Nvidia, Microsoft, and all are well covered in the fund. Performance-wise, I also wanted to share a bit more on why index funds can offer superior performance. If you look at the table at the bottom, we have done a quick performance analysis over the past 10 years. You can see across all time periods, 1, 3, 5, 10 year on an annualized basis, on an index base, the index has been able to outperform its peer group as provided by the Morningstar universe across all global equity funds. Next is the Amundi MSCI Emerging Market Fund. So this fund essentially tracks the performance of the MSCI Emerging Markets Net Total Return Index. It gives investors the exposure to over 24 emerging markets globally across 1,200 securities. So as you can see, the largest EM markets, China and India, are well represented, but beyond that, there is exposure to Taiwan, Brazil, and South Korea as well. Performance-wise, likewise, similar to the Amundi World, it has been able to outperform its peer group across the Morningstar universe of global emerging market funds. And last but not least, before I pass the time over to Ritesh, is our Amundi Prime USA Fund. So because the US market is so dominant, SIFE has also decided to allocate a US-focused fund into the Equity 100 portfolio. This fund is priced at 0.05% per annum and gives exposure to over 900 securities in the US across the large and mid-cap stocks. Performance-wise, you can see as well, done really well over the past 5 and 10 years, generating about 13% returns versus its peer group, outperforming them over the past 10 years. So as I round up my presentation, I hope I've been able to address the 5 key points on why all of us can consider the use of index funds in our retirement. Low cost, definitely, as I showed earlier, fees are as low as 0.05% per annum. Performance-wise, index funds can generate superior performance versus its active fund peer group. Simplicity and longevity, they typically adopt a simple and transparent investment process over the long term, and diversification. It gives you access to a globally diversified portfolio. Yeah. For now, maybe I'll pass the time back to Jason. Thank you.
Thanks a lot, Teresa. So to round up this segment, I'll invite Ritesh back on stage. Here you go, Ritesh.
All right, thanks, Dennis, Teresa, and Darius as well. I think, covered very well in terms of the underlying vehicles and building blocks that we are going to use in our SRS portfolios. Now, obviously, in conclusion, SIFE is committed to bringing the best SRS investments to you, right? So whether you're looking for stable returns, whether you're looking for dividends, whether you're looking to grow your wealth, our low-cost portfolios built in partnership with Lion Global and Amundi, brings you very optimized SRS investment options and helps you secure your retirement as well. So if you look at some of the snapshots of all of our portfolios again, you can see that what are the returns that you're getting from the different options, whether you look at the Flexi on the cash side, the Income Plus and the Core Equity 100, the returns net of fees are highlighted for Cash Plus Flexi. You compare that against, some of these other products that were listed down, where you have to do a lot of like your own, work to get access to these instruments and all as well. And then the returns are much lower. On Income Plus, again, you're getting, high quality access to a world-class, fixed income manager. You're generating stable dividends, and compare that with, a lot of like direct unit trusts. You're paying a lot of, high fees, which can eat away your returns in the long term as well. And similarly, I think last but not the least, Equity 100, obviously if you want to maximize your returns, go for the Equity 100 portfolio. It obviously gives you the highest growth rate. And again, by using Amundi funds, we are lowering the expense ratios to such an extent that it's really standing out if you look at the overall fees that is getting charged to get you that global equity exposure versus if you were to choose an active managed portfolios yourself. So how do you allocate between the different portfolios? Again, the choice is on your side. If you're really trying to just, get a little bit better return than money sitting idle at the bank, obviously, you can go from the 0.05% to approximately around 3% in the long term with a Cash Plus Flexi kind of a solution. And that itself will give you another 44% boost in terms of, generating returns. Obviously, some of the folks were trying to use this block as a more stable building block rather than, loading up fully into equity. So if you want to, invest in a more balanced portfolio, then, a 60% allocation could be done to income, 40%, or you decide, right? You can pick and choose and you can, do an asset allocation yourself, but both the options are available. And that can yield you, again, another boost of, 115%. And obviously, if you want to maximize, then the Equity 100 will give you the highest return. And, again, you might not want to aim for $1 million, but this is an example where you are putting that $15,300 every year into your SRS. So if you put that dollar amount every year, and you put into these different combinations, then this is the kind of projection that you can think of. So from a standpoint of like why use SIFE as your choice of platform to investing your SRS monies, obviously we are an all-in-one platform, so it is not just your SRS. You can invest your cash. You can even buy into individual securities through our brokerage platform. There is no lock-in. You can be very flexible. You can take your money out any point of time. And I think the great thing is there are enhanced tier benefits. So the more you invest, you progress your tiers. So across the three verticals, as you invest, every amount of investment counts to your tier level as well. So the SRS investments will also count to getting your tier into a higher bracket, and then thereby reducing fees and etc. as well. And of course, all these portfolios are managed by my team. So you have the surety that we are managing it and optimizing your SRS investing for the long term. I think that's all that I had from my side. I will hand it over back to Jason to conclude. Thank you so much for attending today. We will be available during the refreshment session. So please do reach out to me, my team, as well as our partners from Amundi and Lion Global as well. Thank you so much.
All right, so I think on the screen you'll see a quick promotion code. If you were to invest your SRS funds up to 200,000, you do get some cash back. Right, if you want more details, you can actually refer to our website or the brochure in your bag. Right, so in the past 90 minutes, I think we've heard a lot from our 7 speakers on SRS investments. I would say that's quite a lot of takeaways. For me personally, it's the first time I'm seeing a magic perform right in our session. Right, so online, all right, for our online folks, if you have more questions, send us an email, advisory@sife.com, or you can just reach out to our client channels. Those physically present, of course, you have the booths and you have access to the speakers as well. Right, once again, thank you everyone for your time here this evening. Thank you.